Jerome Powell's time as Fed chair is over. Kevin Warsh is set to take over. And the timing could not be more dramatic. Inflation is heating up again, oil is pushing costs higher, bond yields are rising, and markets are asking whether the Fed's next move could be a rate hike instead of a rate cut. This is why the Fed leadership change matters. It is not just a personnel story, it is a market story. Powell is leaving the chairmanship just as the rate cut fantasy is starting to crack, and Warsh is arriving just as investors are being forced to rethink the entire interest rate path. On the 15th of May 2026, Jerome Powell's term as chair of the Federal Reserve concluded. The Fed named Powell chair pro tempore, which means he stays in the role temporarily until Kevin Warsh is formally sworn in. That sounds like a technical detail, but markets care about technical details when the timing is this sensitive. The Senate confirmed Warsh in the same week that inflation pressure returned to the center of the market conversation. For months, investors wanted one clean story. Inflation cools, the economy slows without breaking, the Fed cuts rates, and stocks go higher. That was the dream. But the dream depends on inflation behaving, and right now, inflation is not behaving quietly enough. The latest inflation data forced investors to reconsider the path of interest rates. Consumer inflation moved higher again, with energy prices playing a major role. Oil has been pushing up headline inflation, and gasoline matters because households feel it directly. Central bankers often prefer to look through temporary energy shocks, but if higher energy prices spread into broader prices, wages, expectations, or business costs, the problem becomes harder to ignore. That is why the story moved from when will the Fed cut to can the Fed cut at all to could the Fed eventually hike again. So, will Kevin Warsh be more hawkish than Powell? The honest answer is that he may not have much choice. Warsh has often been viewed as someone who cares about Fed credibility, market discipline, and inflation control. Even if Warsh wanted to sound dovish, the data may not give him much room. President Trump, investors, and borrowers may all want lower interest rates, but inflation does not care what anyone wants. If Warsh immediately pushes a strong rate cut message while inflation is rising, the bond market may punish him. Long-term yields could rise, the dollar could strengthen, volatility could increase, and investors could question the Fed's independence. That is why credibility is the first problem. The Federal Reserve does not only set interest rates, it manages expectations, and expectations can become part of the economy itself. If households expect inflation, they change behavior. If companies expect higher costs, they change pricing. If bond investors doubt the Fed, they demand higher yields. Warsh has to convince markets that the Fed is independent enough to fight inflation, but flexible enough to respond if growth weakens. Powell's legacy is complicated. He led the Fed through the pandemic shock, emergency liquidity, the inflation surge, and the transitory mistake. The Fed eventually entered one of the most aggressive rate hiking cycles in modern history. Powell's final years were about fighting inflation without breaking the economy. Warsh is not taking over after the battle is finished. He is taking over while the market is arguing about whether the battle has started again. For investors, the first thing to watch is the bond market. The Fed controls short-term rates, but long-term yields are set by investors. If the 1-0-year or 3-0-year Treasury yield keeps rising, that is the market saying it is worried about inflation, deficits, or Fed credibility. The second thing to watch is oil. If oil keeps rising, headline inflation stays uncomfortable. Even if core inflation looks better, voters and consumers live with gasoline, utilities, groceries, insurance, rent, and wages. The third thing to watch is Warsh's first major speech. Markets will listen for what he emphasizes: inflation, employment, independence, financial stability, and political pressure. One phrase can move bonds, stocks, gold, Bitcoin, and the dollar. If the Warsh Fed sounds more hawkish, expensive growth stocks are the first pressure point because their valuations depend heavily on future profits. Real estate is another pressure point because higher long-term yields can keep mortgage rates elevated and make financing more painful. Gold and Bitcoin can also feel pressure. Fear can help them sometimes, but higher real yields and tighter liquidity can hurt. A hawkish Fed is not only a Wall Street story. It becomes a household cash flow story through credit cards, auto loans, mortgages, and business financing. So does Kevin Warsh kill the rate cut dream? Not necessarily. If growth weakens sharply or inflation cools again, cuts can return to the table. But the easy version of the rate cut story is broken. Markets can no longer assume that cuts are automatic. The Powell era ended with investors still hoping for relief. The Warsh era begins with inflation back in the spotlight. Warsh may have been chosen by a president who wants lower rates, but he is about to face a market that wants proof of discipline. His first challenge is not simply deciding whether to cut, hold, or hike. His first challenge is credibility. The Fed has a new chair, but the old problem is back. Inflation is still the boss.